Well, to join us to give us some insight is van Tiggelen, Senior Investment Specialist at ING Investment Management. Good morning. Thanks very much for joining us.
Good morning.
I want to talk about cash levels first, then we'll talk about what's been happening in global markets in the last 24 hours. As Judith was saying there, a lot of companies have a lot of cash, and you thought maybe this year could be the year when M&A really does bounce back. But the first half was disappointing from your perspective on M&A. Why do you think that was?
Yes, that's true, Mark. You saw, according to data of Merger-Market, that M&A activity was only 8% higher this first half than the first half of 2009, which is actually just a trickle because it's still much lower than 2007 and 2006. The reasons for that, we think, is that in spite of companies having loads of cash, they are cautious about the future, as anybody has still fears about this double dip. Another reason is that they rather hunt for targets in emerging markets than in developed markets. And in emerging markets, there are less targets available at a suitable price. And the third reason may also be that large companies, large caps, actually have been punished in their performance versus small caps over the last 10 years. So you can wonder if CEOs have an incentive to grow larger all the time.
But valuations right now, are they attractive? I mean, is there a sort of correlation between valuations and instability? Would companies rather buy for a higher price in a stable market than for a lower price in an unstable market?
Yeah, definitely. Companies, there's of course an agency risk there. A CEO takes a real risk by buying a big company. And if history is any guidance, they rather take that risk at a higher price when there is visibility about economic growth going forward than at the presently quite low prices actually, but with very little visibility. So apparently they just don't want to take the risk with all the uncertainty about whether we get a double dip or not to look for targets.
In this environment, where we are uncertain about whether we're going to get a double dip or not, what's our best investment strategy, would you say?
We are looking increasingly for high dividend stocks in the more defensive sector. So that means telcos, pharma, oil majors, to a lesser extent utilities, because they have some issues. We think that their dividends, which are usually quite well covered, form an excellent pickup on yield versus the very low yields to be had in the fixed income market. To give an example, on the telecom side, you see many European telecoms giving 7–8% dividend, which is twice as high as their own credit yields and 3 times as high as the bond yields. And they are quite well covered. So we are increasingly looking for high dividends.
Thanks for joining us. We'll speak to you soon. van Tiggelen there.